Now, instead of waiting for NBER to officially declare the confirmation of a recession, an alternative way to identify it is using the US indices quarterly chart, especially the S&P. Now, we will discover exactly how to do that. But before that, disclaimer, what presented here, it is not a recommendation, so please consult your licensed broker. My mission is to create lateral thinking skill for every investors and traders, knowing when to take a calculated risk with market uncertainty and a bolder risk when opportunity arises. Now, how will we know that recession is here? Now, typically, economists call a recession when GDP and not S&P, when GDP has declined for 2 consecutive quarters. Now, it is this committee called the National Bureau of Economic Research. They are responsible for officially declaring when recession starts and when it will end. But the problem is that we will have to wait for June to settle, and it will take a few days or perhaps a few weeks for the GDP number to be out, and the committee will gather, and from there they will discuss. May take another few days to a few weeks before they declare that recession is here. But over the years, I felt that what I have this little hack that I use is pretty effective for my investment and trading, that I've been using the S&P index quarterly chart to identify if recession is going to kick in. Now, what we could see here is a quarterly chart. Now, every candlestick that you're seeing here is 3 months. Now, I've pre-prepared for easy reference that over the 22 years, for recession, there were 2 recessions based on GDP, but based on the S&P using the same techniques as well, I study into a quarter chart. Now, let's go and look at the dot-com bubble. Before the bear market kicks in, we have 2 down quarters, as you could see, over the last 22 years. Once they have 2 down quarters, it will follow by bear market. But based on GDP, it is called a recession. The economy has entered into recession. But based on my S&P, on 2 down quarters, we have a bear market. And moving forward, we have the subprime crisis. Similarly, we have 2 down quarters out of the 22 years, 2 down quarters, and then followed by a few down quarters, and that's called the bear market as well. Now, moving forward to the current, that the first quarter was a down quarter, and followed by this quarter, highly likely is going to settle as a down quarter as well. So we have 2 down quarters, and this is what I see here, that highly likely we will enter into a bear market. And can I say this, that this bear market, it is just at this beginning based on the studies that we have. Now, as an investor, what I do is that I'll keep my position, my long-term position, really light. And to me, I have this concept is that when you know that bear is at the beginning, liquidity to me is king. Why? Because I would like to reserve more liquidity when opportunity strikes, when the market came off, it's become lower, it's became cheaper, became a value buy, then I will still have the reserve to acquire more shares. That's what I do. And I prefer not to hoard to too many stocks. I still have some exposure, but I'm pretty light. Now, how about being a trader? Now, being a trader is this. Maybe what I do is that now I will switch over to the daily chart. Now, so this is my daily chart here on the ES, the E-mini S&P here. Now, in a bull market, the concept is really simple and straightforward. So is the bear market. In a bull market, what I do is that I will gather all the resources I have, which is all we have, the resources as well, the time that we have and the energy that we have and the finances that we have. Now, in a bull market, being a trader, I will try my best to buy on dips when opportunity arises. That's what we could see over the last before year 2022. Buy on dips. So at the crossover of 2022, the bear has arrived and at the settlement of June, highly likely we're going to enter into a bear market. So it makes a lot of sense to reverse this strategy. Since the bear is here, I will try to focus on sell on strength when opportunity arises. And it makes a lot of sense to do that because we are going with the flow, we're going with the trend, which is the bear market. But that does not mean that I do not buy. I will still buy when opportunity strike. It's just that since I'm going against the trend, I will keep my position really light. Now, what I do is that I light the micro E-mini S&P since they've launched about 3 years ago compared to the E-mini S&P because the quantum is 1/10 much smaller, so I can trade multiple lots. That's what I do. And why do I like to use S&P? Now, you could go ahead to use the Dow Jones or the Nasdaq. It will give you the same reading. But what I like about S&P is this, because Dow Jones, it measure a basket of 30 stocks. That's quite limited. It does not really represent the whole broader market. Nasdaq is too focused on technology, whereas S&P is a measurement of 500 companies, from the largest to the smallest, with various industries. So it is commonly used to benchmark for stock portfolio performance in America. Now, what I'm going to do here is that I'm going to go back to the quarterly chart. I know you like this. And so feel free to leave me any comments below. I would love to exchange great ideas with you. And for more market insights and techniques, I hope to see you again very, very, very soon. Continue to explore this topic with these related videos and register for these webinars as well. Follow my Facebook page for my daily market insights. To be updated with my latest video, subscribe to my channel and remember to turn on the notification bell. See you again very, very, very soon.